Hi guys, Boris Dorfman here, your favorite fund manager from LBC Capital Income Fund. I'd like to do a long-awaited market update. I used to do this more often, but we're going to talk about the stock market, we're going to talk about interest rates, and we're going to talk about real estate market. My specialty is real estate market in California. There haven't been enough transactions in commercial space over the past 3 to 5 years. Everybody's waiting for something, mainly lower interest rates. So the market is a little soft. Residential market started to pick up a little. I do not see prices falling for residential market in the next few years. And I think commercial activity will start to pick up, but it will depend on a sector. Commercial overall is still a little soft. That being said, you can get mid-fives interest rate on commercial properties today, which is significantly lower from 7+ that we've seen just over a year ago. So that's pretty healthy. Interest rates. So interest rates have dropped again significantly over the past year and more. Today we are at the lowest level in 5 years on the interest rates, I believe. And you can get residential mortgages at around 6%. You can get commercial mid-fives. You can get FHA and adjustable on residential in mid-fives as well. We're still due for 2 federal rate cuts this year. Most of them are priced in to the market already. There is a lot of uncertainty. Market does not like uncertainty, so there's a lot of uncertainty in the markets, right? But I think at least for the next year, I'm very optimistic. So there's 3 things that we are awaiting for that should drop interest rate in a short to mid run. One, obviously, Fed. Not only that they're going to cut twice this year, they'll probably cut more next year, but also their guidance when they come out with their statements, what are they going to do with at the next meetings? So that's one. Interest rate cuts by federal government. 2, Trump administration is talking about privatizing, getting Fannie and Freddie Mac back out of conservatorship. So these companies are going to change. They're not going to be under government conservatorship. So that's going to change a little bit, and it's going to be a good change for interest rate. They also talked about consolidating Fannie and Freddie Mac, which is going to make these institutions more efficient, therefore possibly having a dent on interest rates as well. You know, most of the mortgages are guaranteed by Fannie and Freddie. And 3, well, there's 4 things. Bank deregulations. We'll see what maybe reserve ratios. Banks, still small to mid-sized banks, are not very, they're very restricted. Part of it is by regulation. We may see some bank deregulation. And 4, since we printed so much money, U.S. government did, over COVID, the government has been reducing the size of the balance sheet, right? So they printed all this money, they put it on the balance sheet, and they haven't been buying more, and they have been running off and selling mortgage-backed securities and bonds. The minute government comes in and starts buying more bonds on the open market, interest rates should drop. Okay, so for now, federal government has been still reducing their balance sheet at a much lower pace as they have been a year ago, but still they're selling off. They're not sellers, not buyers of mortgage-backed securities and mortgage bonds, but they will change their stance, and they may take a more neutral approach where they're not going to be selling, or at some point they may be even start buying, maybe not anytime soon, but they will certainly change the pace of the runoff from the balance sheet. So these are the 4 things. In the next few months, we'll get more clarity that will be open, will change the way interest rates for mortgages look like, both residential and commercial. Now, we got crypto, we got gold, we got stock market. I mean, all the markets are having one big party. It's not going to take much to drop everything. The best analogy for the stock market we have is the year 2000 .com bust. So now we have an AI boom. So be very careful on your allocations into the stock market. Gold is through the roof as well, overvalued. Of course, we saw what happens when markets go down. Everything goes down at the same time. We saw it during COVID. Your Tesla stock goes down, gold goes down, oil goes down, because people are and institutions are selling good assets so they can meet their margin calls. So be very careful of how much of money you allocate where. This is not an investment advice. This is what I would do. Follow Warren Buffett. Well, he's not a CEO of Berkshire Hathaway, but Berkshire Hathaway is about 40% in cash. They have close to $400 billion in cash ready to be invested. Think about it this way. In year 2000, when .com busted, Nasdaq fell 78% from peak to bottom. Broad market fell 49% from peak to bottom. You know what Berkshire Hathaway did in the same time period? Berkshire Hathaway went up 80%. This is the value investing strategy that Warren Buffett did not come up with, but he perfected it. It wasn't his idea, it was there. But Warren Buffett and Charlie Munger, that's what they did. Again, from peak to bottom, 79% Nasdaq drop, 80% Berkshire Hathaway stock went up. While everything was, there was blood on the street. All the stocks were crashing. Be very careful with your allocations. Don't have everything in Tesla and Apple stocks, which are still great investments long term, I think. But, the party is going to be over soon or not soon at some point. But, make sure to clean up and to be ready. So that's my market update. Don't forget to sign up to my channel. I may do updates more often. If you have any questions, please drop me a line. If you have any comments, do so. Like and subscribe. Thank you, guys.